Hey everyone, welcome back to the channel, and this week we are discussing a very important topic, not really related to what we've talked about in the last couple of weeks regarding crypto and options, but this week we're going to talk about quantitative easing, which is an economics concept, and it actually has to do with inflation and exactly what and how the money supply moves. And this term is thrown around a lot by the Fed and other central agencies, so it's important to understand exactly what it means, how it works, and how it affects the economy for both investors and for everybody in their everyday lives. So hope you can take something away from this, and I'll see you all next week. Hello and welcome back everybody, and today we're doing a bit of a different lecture on quantitative easing. And this sounds like a very difficult concept, but it's not really. So there's two main sides of the coin for this type of monetary policy. Now, monetary policy has to do with the central bank. In this video, we're going to discuss quantitative easing, but on the opposite end of this policy, we have quantitative tightening as well, which we will not be discussing here. So the basic question, what is QE, or quantitative easing? It is the process with which a central bank buys back government bonds, other bonds such as municipal or corporate bonds, or financial instruments such as stocks or other assets in that class in order to increase both the volume and the flow of money in the economy. Now, the main use is in an environment where interest rates hover around zero. What this does is this actually causes investors to want to hold cash or other liquid assets such as stocks in order to forego the low return on government bonds, because these rates, as indicated, are around zero. In this case, quantitative easing is utilized in order to stimulate the economy, which is an effort to stop the rate from being lowered even more and becoming negative, meaning you don't get a return at all. This scenario, when interest rates near zero, is called a liquidity trap, and this is due to the surge of capital to liquid assets from the bond market. Quantitative easing is a common last resort method when other monetary policy is not working as it should for the central bank in order to stimulate the economy. When the central bank buys financial assets or bonds in quantitative easing, the prices of these securities rise due to the increased demand, and actually raises stockholder wealth. This creates a selling surge as investors collect profits, and it also creates an economic boost because this increases consumption. And this is the key here to increase the economic well-being. It's commonly used in critical scenarios as a tactic in order to fight against the economy retreating into a recession. And again, this is done by stimulating it to increase consumption. Oftentimes, QE is too aggressive and it's overdone, which means it overcompensates for deflation and actually creates inflation in the longer term, which isn't necessarily ideal. And this is exactly what happened during the COVID-19 pandemic, actually, and this is what led to that inflation when QE was overdone in March 2020. The central bank itself decides to conduct QE in order to improve financial conditions mainly, but it also does it to increase liquidity in the markets and to increase lending by private banks. Now, the fourth largest QE event in the USA in history, famously called QE4, was actually in March 2020 in response to the international lockdown that ensued. The Fed announced a $700 billion QE policy, which by July had grown to over $2 trillion in assets purchased. Almost triple what they initially wanted. So now we can take a look at this as a spike in the total assets that they have. You can see that huge spike of over $2 trillion during the pandemic. So QE subsequently actually reduces the overnight rate, which is the rate at which banks are able to lend from the central bank. And this leads to higher amounts of lending and loans in the economy, and to more risky banks and financial entities having access to these loans. So this has pros and cons, of course. Bond prices also rise due to the influx of demand contributed by central bank buying. And bonds have an interesting property, if you're not familiar with it, that when their price rises, there is a negative relationship between it and its yield, so the yield actually falls. And this, of course, leads to a flow of capital to equity markets, which once again increases consumption. Now, the very important topic that everyone discusses on the news and everywhere else is the effectiveness of QE, and it is heavily contested. So, of course, central bank research favors it, and independent research is less optimistic and doesn't even sometimes show a difference at all. But in the United States, however, QE has actually been found to reduce longer-term interest rates on various securities and actually reduces credit default risk. This is a very interesting finding. Perhaps this is due to the less interest needing to be paid by higher risk lenders and allowing them to remain solvent. With a longer horizon, QE leads to moderate inflation hike, which means small if anything at all, and significantly boosts GDP figures, which is that economy stimulation that we talked about. Studies are mainly based in the UK, however, for this. Now, another very influential component of QE, especially during COVID, has been the widening of the wealth gap, and this is very controversial and very touchy. Mainly, this is caused due to the flow from the debt to asset markets. The inflation in equity prices increases the gap between the wealthy and the working class. And this is a very big problem in terms of equity and equality. As before mentioned, QE is linked to inflation, mainly in instances where QE is overdone and overarched, and too many assets are purchased, which again leads to higher inflation measures. The reduction of the yield on debt through QE also aids the economy by deleveraging, which means reducing debt, of companies that have a lot of leverage. If significant amounts of inflation do arise from QE, it can be actively battled through the economic growth that is stimulated through quantitative easing. If growth outpaces this inflation, there's a very positive overall result for the economy. And in this case, inflationary pressures become negligible and we get that positive outlook. QE benefits debt holders too. So lower interest rates actually mean that any credit can be paid back with less interest, and of course this favors the debt holder. But it actually does have a negative effect for asset holders since the yields are lower, which means a smaller return is made on any investment that has an interest rate. The inflationary pressures that are introduced through quantitative easing have some widespread effects, and they don't only just depreciate the currency, which is a large negative of this, but through this actually harms importers of goods into the country, since it's more expensive to purchase abroad, and benefits exporters who sell abroad for stronger currencies getting a higher return and actually pay less to produce the goods domestically. Overall, quantitative easing's effect on interest rates discourages saving and stimulates spending in order to stimulate the economy. And this is the overall and overarching goal of quantitative easing. But pension funds are one of the hardest hit by this, and quantitative easing is not in their favor since they want to look at safer investments such as government bonds. But quantitative easing makes this very hard because their yield actually no longer outpaces inflation. So I'll see you guys next week.